So today we have with us CA Abhitan Mehta, who will be dealing on buyback of shares, capital gains and corporate gifting, the points we need to take care of. And to give a formal introduction, I would like CA Nidhi Lalpuria to please take a formal introduction.
Thank you, convener, for the opportunity. I've been given a pleasant task to introduce Abhitan. Mr. Abhitan is a fellow chartered accountant and has done LLB. Mr. Mehta did his articleship from Price Waterhouse and post-qualification has worked with Bansi S. Mehta and Company, and now he's working as a transaction advisor at BDA LLP with Sri Gautam Doshi. He has garnered wide range of areas covering mergers and acquisition, IBC takeover, succession planning, international taxation, accounting, FEMA, and corporate laws. He has been actively involved in conceptualizing and implementing a number of acquisition and restructuring transactions. He also served as a member of International Tax Committee and IND-AS Committee of WIRC. He's also served as the youngest chairman of the Direct Tax Committee of the Chamber of Tax Consultants. He's also regular speaker at professional forums and has contributed to various articles and various books like Impact of 56-10 on Corporate Restructuring and Trust Structures, Demystifying Section 194R, Impact of GAR on Trust Structures, and Outbound Structuring Post BAPS. I welcome Abhitan and I request Rishabh Jain and Sima Mehta to come forward to give a memento to Abhitan Mehta, please.
Good morning, friends. Food was smelling really good. So half of my job is done. We have very basic but very interesting topic of buyback and capital gain. And we'll touch upon corporate section. The most have already heard Nihar Bhai on the finance bill. So I cannot really add anything to the broader overview and analysis of the finance bill. One is trying to touch few nitty-gritty and advances of few of the tinkering or the amendments done by finance bill and few overhauls like taxation of buyback done by finance bill. One of the most tedious aspects of this finance bill, if one wants to read, is just to determine the date from which the amendment is happening. For capital gains, we have, I think so, 3 to 4 days or 5 days from which the amendments are made applicable. One is 1st April 24. I'm talking of transaction dates and not assessment. Few amendments are for 1st April 24. Few are for 23rd July 24. Few are or one set is for 1st October 24. Few are for 1st April 25. And one is for retrospective April 1, 2018. So in all this, 5 dates to dissect which amendment is applicable from which date. And if you miss the slightest error, could result into sea change in taxation. Just for example, we have this onerous category now of specified mutual fund, in which your gold ETF and foreign ETFs were also inadvertently covered last year by the definition of specified mutual. So they agree to that mistake. They said that this is not the intention. But when the host of amendments are made from 23rd July, this removal of gold ETF and foreign ETF is from 1st April 25. No particular reason given, but it is from transfers after 1st April 25. One presumes that majority amendments are from 23rd July. So now if the client wants to liquidate any foreign index or gold ETF, he'll have to pay as long term depending on period of holding. But no, he'll have to liquidate after 1st April 25. If he liquidates before 1st April 25, the old law applies and it will be deemed short term under 50. We'll go through that, a series of such nuances, and it only has transitionary impact. Starting with the biggest transitionary impact of the budget is buyback. For private space, even for public space, you see the numbers are dazzling. Last year, buyback was more than 1,50,000 crore was done as buyback. Why buyback was the preferred route? Everyone knows the comparative tax rate of buyback under 115 versus dividend is at 35%, 35.88% at the highest rate. And buyback, presumably everyone says it is at 23.3%. So there is an arbitrage and therefore one needs to prefer buyback. And that was the only available route, so to say, to extract money from the company, or the route which has the least tax today was buyback, and that was being used across the board. Is it new? No. Using buyback and taxing buyback as capital gain was done way back in 2000 when 46A was inserted and exemption was provided to 222. That a buyback under 68 will not be regarded as dividend. So it was there on the statute. Then we brought in 115 QA, a specific additional income tax on the company. That if the company does buyback of shares, the shareholder is exempt, but the company has to pay tax on the distributed income. What is distributed income? Simple. Buyback price minus issue price. You whatever is the amount is the distributed income. If it was issued for 10 rupees, you are buying back for 100. 90 is the distributed income, and you pay 23.3%. Means 20% plus surcharge and cess. 23.3% tax on distributed income. If the issue price is slightly concentrated, like various transactions, there was a rule 40 prescribed in case of conversion, merger, etc. That how to compute what is the issue. So this regime has been there fairly for I think so 7-8 years or more now. Earlier it was only for private companies, then it was also added to for listed companies 4-5 years ago. So why? So now they want to do away with this. Very simple 3-line amendment to the definition of dividend. Yes, sir.
Now, what about bonus share and right issue?
Everything, sir. Everything is buyback option. Sorry?
How will you calculate the price?
That bonus shares in it and right shares, whatever you pay.
Capital is price over.
Sir, slightly unable to do it. For my case.
I applied for buyback of full action. Which includes bonus also, and also all the. But how the company will calculate?
First is, there are two issues. One is which shares to be selected. Is that your question? Then it goes by specific identification if it is physical shares. If specific identification is not possible, it goes by FIFO method. It is there in Rule 40BB. Yes. So what is this is one very fundamental question. What is the buyback tax rate under 115 effective tax rate for buyback? 23, sorry, 23.29%. 10% for public. 23 unanimous view? Anyone? Any other view from? I heard someone saying something else. 23%? Sorry? Right, sir. No, sir, that is common even for dividend. You have to pay 25%, 35%, whatever. But when I am comparing, what is the comparison? Is dividend versus buyback? Dividend, everyone, 35.88, unanimous. Buyback, what is the rate? As the font is slightly small, I'll read it out. Let's take a simple example, you have 100 rupees. Okay, if the company has 100 rupees total, wants to do a buyback, it will do a buyback for 89 rupees. Pay 23% tax, which is 18.9. So that the 100 rupees has gone to the shareholder, 89 as buyback price and 18 to the government, and the receipt is exempt in the hands of the shareholder. If for the same 100 rupees, if I declare dividend, I have to declare dividend of 100 rupees. I have to pay 35.88. So the tax is 35.88 rupees. So if you see, the delta is really 17% and not 12.6%. We calculate that 23% is the rate, but we miss that the tax is on the company and not on the shareholder. So it is what goes to the shareholder is really net of tax. If you consider that aspect and assume that you have 100 rupees in the bank account, in buyback scenario, 79 would reach, not 89, but 79 shareholders versus 65. Then it is 17 rupees of 17% difference. For 100 rupees, 17 rupees more goes to the shareholder. So now, simply this is taken away. Going forward, from 1st October, this buyback provision of 115 QA will not. So, as a matter of transitional impact, one may assess that should I do a buyback in next 1 month? Whether is it worth saving this 17 rupees of delta and transferring money to the shareholders? Or we are happy with the funds in the company and let it continue. There is no need of doing it. But if one concludes that let me transfer it, then the question comes is the buyback possible in this timeline? Already a month or so, we literally have 1 more month remaining. Can I complete the buyback process in a month's time? The steps are too many if you want to read. Yeah.
the last slide, the tax on dividend was in the hands of shareholder,
Yes,
25.88.
yes,
That is the highest.
yes, yes. So, is it possible? In one line, the answer is yes. If you see the statutory timeline in the Companies Act to do a buyback in the 68, it is widespread. You call because you prepare the documents, you call a board meeting, then you give a notice to EGM, call an EGM, then give the buyback offer, which can be up to 15 days, then park money in escrow, then do payment. But all the provisions have a caveat or a possibility of being done at shorter notice. In a privately held company, board meeting can be called today and shareholders meeting can be called even tomorrow. So, and the period for buyback of 15 days can be curtailed to 2 days or 5 days, whatever you like, with consent of all the shareholders. So the rules are very much there in company law itself to curtail all the periods. And one has practically seen in 10 to 12 days, you can complete a buyback of private. 2 or 3 general impediments. You need accounts, limited review accounts, because earlier your March, if you are passing a March account, it is okay. If you have March 24 audited accounts, it works. But if the audit is not closed, you need a limited review account. You need an auditor certificate, and also you need a escrow account to be opened with the bank, which itself, sometimes takes 3 to 5 days or 7 days. So that process one has to initiate simultaneously. But practically, it is very much possible, and people are doing that, completing a buyback within a span of 10 to 15 days. So it is worth evaluating even now that should we do a buyback in next 1 month's time. Similar is the case of listed companies. If you see the SEBI regulations as well, if you have, say, assuming the board meeting on Monday, though there is a notice to SEBI before that as well, but assuming I've just taken that if you have on Monday, even if you follow the statutory period, you will complete the buyback on 27th September. And if you curtail the, you can complete it as fast as 30 September. Because in SEBI, the period for the offer is only 5 days and not 15 days. So therefore, even for listed, it is possible to commence and complete the buyback in next 1 month's time. So this is one time window. If one thinks of exploring, there is still scope. That's all I wanted to communicate. Now, coming to the law going forward. The law is simple, that now any buyback in accordance with section 68 of Companies Act would be regarded as dividend. Dividend, whatever slab rate you have to pay that, you will pay that. Very interesting or unnecessary thing to my mind is they have done. Now, buyback is to be regarded as dividend if you whether you have accumulated profits or not is irrelevant. All the provisions of the definition of dividend clause A, B, C, D, E only apply in case of you having accumulated profits. Buyback is the next F provision which has done away with this condition of accumulated profits. So if a company is into losses and does a buyback, or typically a startup is into losses and there is a fresh issuance and has done a buyback for exit, it would be regarded as dividend though it doesn't have any accumulated profits. So unnecessary to my mind, but that is what the law is. So now the general concern is buyback, you tax the entire receipt. In an example, 10 you share you bought back for 100. tax 100 as dividend. So what about my cost of 10? So they are saying in 46A that cost will get as your long-term or short-term capital loss. So if you have any other income, which is long-term or short-term capital gain, depending on the set of provisions, you can set off. But you have to pay tax on 100 rupees as dividend income, because capital loss cannot be set off against other sources. Section 57, allowing deductions in the context of dividend taxation, has been amended to provide that no deduction to be allowed in the context of dividend from buyback of shares. So you will not get any deduction under 57 for dividend arising from buyback options. TDS, the company will have to do a TDS at 10%. So that is also amended. This is the primary change. Any thoughts or questions on the basic?
Suppose I have purchased shares of one share at the rate of rupees. At the rate of rupees 1,000 today, and after 10 days, the company has announced buyback at the rate of rupees 9. After all, I am loss of rupees 100. What about it?
Very interesting. So if I have purchased and for 1,000 and within a short period of time, say 10 days or so, I am tendering the shares for buyback. Made for 900 rupees, maybe for 1100 or 1,000 itself. How would it go? Dividend, first question is, what is then the nature of purchase? Is it a capital asset or is it a stock? Irrespective of that nature, if we ask that for a moment, whatever you get as buyback price from the company is taxable under 56 as dividend. It has a specific entry of taxation as dividend. But if it is regarded as a capital asset, then I will have short-term capital loss in the example survey of 1,000, which cannot be set off against the other things. But if this is regarded as business and stock entry, it is a good case to say that it is a business loss. And business, current year business loss, you can offset against other sources. There is no amendment in 28 or any section of business head to deal with this subject. But it is simple that if it is part of your stock, it would say be reflected in your purchases, it is purchase of the current year or opening stock. And it is not in the previous stock. So automatically it is factored in your computation of profit. And if there is no other item, the profit will come to negative 1,000 or negative 1,000 rupees. One very technical issue, to my mind, it is not the correct way, but section 46A doesn't use the word capital asset. It only uses the word purchase of shares by a company. Doesn't use the word capital asset, but the placing of the section and the entire scheme of the section 46A and with 48 and everything. The better view is 46A only applies to capital asset and it doesn't apply to shares which are held as stock.
Basically, when the stock, it has been converted, it has been purchased at the investment. But before buyback, it has been converted to stock in trade.
Right.
Then there will be a, whatever the loss will be there, that can be set up against it.
Yeah, I'm not too this nice. So let's run the chain. First 45 you would apply. 45 you would say you have converted, but you pay tax when it is transferred. So 100 rupees is converted for 500, 400 is your tax. And now you come to stock, the value is 500, you get 0. And you're assuming the buyback is at 600, 600 is dividend, 500 is capital gain, and 500 is loss. So 500 capital gain, 100 dividend. But each,
Sir, what about balance sheet?
sorry, sir?
Balance sheet. The company can be wound up because by company has got 3 crore,
Hmm.
they pay in for a dividend share. So company can exchange it.
No, sir, you can only take 25% of net worth on buyback, not beyond. Section 68 has a,
Dividend limit is not there.
there is no change on dividend process on the amendments. That is what can be done today, can be continued. So one issue which I mentioned that if you don't have accumulated profits and if you do a buyback, you have to pay dividend tax. If that is causing a trouble, you can always do a capital reduction scheme. Because capital reduction is taxable under 222B, where this requirement of accumulated profits is there. So the same commercial outcome can be achieved through a capital reduction scheme, which would be regarded as capital gains and not as dividend. Subject to that lengthy NCLT process which one has to. A question would arise if a listed company was supposed to do the buyback after October 18, whether you will get the benefit of the grandfathering price. Because grandfathering price 55 AC is comparison of full value of consideration and the 31st January price, whichever is lower. Now 46A deems the value of consideration to be nil. So whether you can get the benefit of grandfathering price, to my mind, still yes, you can get it. But subject to litigation, it is a very nuanced reading. 46A says value of consideration for purchase and is deemed to be nil versus 55 to AC says full value of consideration accruing as a result of transfer. If you see the transfer is of shares to the company and the full value of consideration is really the buyback price. So one could read it in a manner that the grandfathering price benefit is still available and you get the higher loss, but highly debatable to my mind. We have discussed if it is held as stock in trade. Some discussions came around that whether 47(4) would apply of buyback from purchase from wholly owned subsidiary. We have 3 ARs to say that 47(4) only applies for 45, doesn't apply to 46 days. Buyback is outside 47(4). Interestingly, you have a decision of Madras High Court that if there is a buyback, say by your subsidiary, and you have carry forward business loans, buyback is taxable as dividend. Dividend is under 56. Ideally, you are not allowed to set off carry forward business loan. But you have a line of decisions that the carry forward business loss can be set off against business income. Not necessarily the income is chargeable under the head PGBP. So if a business income is chargeable under 56 like dividend, you can still set off the carry forward loss. You have a direct decision of Madras High Court in the context of dividend, which was from business investments. They have said that you can set off the carry forward business loss, though the dividend is taxable under 56. ATM, the benefit will continue. Example, a subsidiary has done a buyback, the money is received by the company. Now, if company, even if they declare a simplistic dividend to the shareholders, because it is dividend received from the subsidiary, it will be passed on to their shareholders. So, a very interesting concept would now evolve, very fast specific. But assuming I have a subsidiary and I also have my own business or other investments. I have sold my investments or my business. I have a capital gains of 100 crores. I have substantial investment in my subsidiary, say 500 crore. I do a buyback for 100 crores. So if I do a buyback for 100 crore, what will happen is 100 crore would be regarded as dividend in my hands. And at the same time, because of 46A, I get a long-term capital loss of 100 crores. Because the buyback price is nil, everything is taxable as well. So against my income from sale of other investment, I'll set off the buyback loss. And the dividend which is now there, I can upstream and use APA. So practically one has converted a capital gain into dividend and has upstreamed it. And will have only one incidence of tax in the hands of the shareholder. So very fact specific, I said. The new question under the new law is buyback, linked to the earlier question. Easier. So example, if I invest 100 crore in my subsidiary, on next year, I do a buyback for 1 crore, the entire 100 crore shares. So dividend, there is no limitation. I have to pay tax on 1 crore. For the capital gains, my cost of the shares was 100 crores. So I'll get a loss of 100 crores. Then the question arises whether 50 CA will apply. Because the value of shares which I have surrendered for a token consideration, whether department will apply 50 CA. Let's park this complex example aside for a minute to understand 50 CA. I have shares of say 25%, 25 crores I have shares. It is bought back at 25 crores. So 25 crores I have to pay tax as dividend income, correct? Now if I come to capital gain chapter, 46A says my cost is 25 crore and consideration is 0. So I have a loss of 25. Now if I go to 50 CA, if I compare my consideration, which is 0, deemed to be 0, with 50 CA value 25 crores, then my full value has to be 25 crores. Then 25 crores minus 25 crores, my loss is 0. So I will not get a loss if I apply 50 CA in this type of buyback provisions. If it cannot apply to a normal provision, it will not apply to absurd 100 crore and 1 crore spaces well. Even if you see the explanatory memorandum, they have given an example of computing capital gain and what is dividend in case of buyback. Over there also they have not applied 50 CA or considered, though there is no positive statement as well that 50 CA doesn't apply, but at least they have not applied it. Otherwise, you will always have a taxable income in capital gain, unless the value has actually eroded. Therefore, on fundamentals it cannot apply. Even on technicalities it cannot apply, because 46A itself is a deeming fiction. You cannot superimpose another deeming fiction over a deeming fiction already created. It deems your value of consideration to be nil, and therefore you cannot come to 50 CA, which needs a comparison with the consideration. Similar controversy is there in 45.3, contribution to a partnership. whether 50C or 50CA applies. Because 45(3) deems the book value that of the contribution as the consideration. There you have tribunals to say that you cannot apply two deeming fictions together. So, good case to say 50CA doesn't apply. So, the use of buyback which was done post 56 to 10 was also for realigning the shareholder, where 56 to 10 doesn't apply. Because if you transfer shares or gift shares, subject to the definition of relatives, 56 to 10 would apply, 50CA would apply. 115 QA and 1034A provided a framework where you could realign the shareholding through buyback, where no adverse consequences were there, even if it is done for a token price. That, to my mind, continues even under the new regime of buyback being taxed as dividend. That possibility of realignment through buyback without any fair value consequences would should continue. So now we have understood what is buyback. What are 2-3 avenues available in case of still having repatriation of money from the company to the shareholder, which is not regarded as dividend? To my mind, only one is redemption of preferences. 115 QA tax any buyback of shares under any provisions of the Act. 222F is categorical that only a buyback under 68 is covered. Therefore, preference share redemption is under 55. It was debatable whether it is a buyback covered under 115 QA or not, because Supreme Court has regarded in Anarkali Sarabai's case even redemption as a purchase by the company. But that controversy is not relevant now. But redemption of preference shares is something still outside the ambit of buyback. So one is certainly if you have dividend or not, preference shares, you can redeem. If you don't have bonus preference shares, redemption would be regarded as dividend. Not because of 222F, 222A itself will regard the redemption of bonus preference shares as dividend. The way one could get preference shares on the books is through some restructure, either on merger or demerger or a reverse merger into a subco. You can issue a mix of equity and preference to the shareholder. And then if you redeem those preference shares, it still should be outside the dividend tax. You will pay capital gains tax at 12.5%. No escaping that, but at least you will not pay tax at 36%. Similar.
Redemption of preference shares is also under section 68 of the Companies Act.
No, 55.
The same criteria of 25%.
No. Nothing. 55 doesn't have 55 says, as per your terms of issue, you can redeem your preference shares. It could be redeemed only out of profits or out of a fresh issue. But has debt equity ratio, 25% limit, all those criteria don't apply to redemption of preference. If you do buyback, then you go to 68. If you redeem, because redemption terms can be flexible, it can provide at the instance of the company, need not provide a fixed date from the date of issuance.
So even if the redemption of the issue date is different, that can be perfect.
Yeah, it can be more. Stage like merger, demerger, it holds good if you are converting a firm or a sole proprietor into company. You can consider a mix of equity and preference. So that gives you the flexibility of redeeming preference on a future date. These are few remote concepts. I'll just summarize in a minute. If equity you can convert into preference share, either through a shareholders meeting or through NCLT route is debated, but certainly you can do through the NCLT route. And then if you redeem those converted equity, would then be section covered by 55 and not by 68. You can do a buyback of CCD and OCD, which is again outside 68. 68 only deals with buyback of shares, doesn't deal with buyback of CCD or OCD. Also, the section only talks about buyback under Indian Companies Act. So any buyback by a foreign subsidiaries continues to be governed by 46A and is not governed by 222. This is the one another small point earlier, and this is covered because of more of WhatsApp as well. That if you do a 230 scheme for buyback, you had earlier in 115 QA, if you see the language, it was earlier to only cover a buyback under section 68 or really section 77A of Companies Act 1956. Because in 1956 Act, you could do a buyback through a scheme which is not in compliance with section 77A. For example, you may buy back 30%, 40% shares through a scheme. You don't have to comply with 77A. So earlier, Cognizant wanted to get out of 115 QA. It did a buyback through the scheme. And a mega litigation is going on because the amount involved itself was 19,000 crores. Was the buyback done and funds were repatriated to foreign country. So the taxation is a big dispute. Today, the tribunal application against them. But this avenue of doing a buyback through a 230 scheme is no more available because of the explicit language of 222F. It requires that buyback is in accordance with the provisions of section 68 and not under section 68. And if you read the company law section 230 subsection 10, any buyback under the scheme should also be in accordance with the provisions of section 68. So the language is verbatim. So even if you do a buyback under 230, it is in accordance with 68, and so it will be hit by 222F. Yes, if you see buyback under Companies Act, let's put it there are 3-4 ways in which you can do a buyback simply settled. But one is to redeem the shares, which is 55. One is capital reduction, which is 66. And one is buyback under 68. All three come to the same economic conclusion. But it would depend on which process you follow. You may call it buyback under 68, then you are hit. If you call it redemption under 55, you are not. If you call it capital reduction under 66, you are hit to the extent of accumulation. So it is really just the process which you follow on this side. So, the most interesting query which I have received through after this budget is on use of this 12.5% coupled with closure of this buyback code. So assuming you have a company has a net worth of say 15 crores. For simplicity, assume it is only 15 crores of cash income. When the business is sold, it is all in the liquid interest. Now, if you want to close down the company, certainly it is all made up of your accumulated profits. So either you declare dividend or you liquidate your to the extent of your accumulated profits, you will pay dividend tax at 36% roughly. So what if one does a conversion of this company into a 4713B exemption is only for asset up to 5. So the exemption is not fair. So it is a non-compliant conversion of the company into LP. So two stakeholders, one is the shareholders will get interest in LLP and the company is getting converted, so to say, in LLP. So for the shareholders, reasonably clear that if you have acquired these shares for 1 crore, on 15 crores, pay capital gains tax, 12.5%. You will pay tax following the dominance area and the principle of grace periods. Other arguments there, but not getting into other. To my mind, the better view is shareholders starting with. When you come to the company only has, say, cash. So on conversion, there is no capital gain. There is no tax on the company. If it has liquid investment, the risk is minuscule to the level of appreciation. Or pay tax on the appreciation. Assets you have to pay tax. Liquidated those investments. But the hands of the company. Overarching argument is always of tax. Putting that aside for a minute, though it is a very strong argument, you don't have to pay tax in the hands of them. So what is happening? The company needs to exist now. 15 crores of cash, 15 on the partner's balance, 12.5% tax. It is part of your capital balance. No 45, 5 or 90, 45, 4 or 90. Because this is not revaluation. It is part of a capital balance. You can withdraw anytime. So simply a non-compliant conversion would bring you down from 36% to 12.5%, which is 15% of tax rate. If you even complicate the example to a that instead of only cash, you have a running business and a surplus. For the surplus, the same principles which we discussed would apply. There is no change of those principles being applied. For the running business, now section 50B has been amended. Last couple of years, it was amended to provide a valuation rule which broadly tax you on book value. So unless the land and building has significantly appreciated, the tax is most of the time minuscule or on the difference between the WDV and the book value of the plant and machinery. Stamp duty is debatable. If there is immovable property, again, though there are high courts that stamp duty should not apply, but practically they are charged. So you will have to factor the stamp duty cost at least on the immovable property. Don't see significant cost when it comes to movable. Only one point of caution, what we have been advising is, don't withdraw immediately. Do this. If there is no hurry, don't withdraw. It is, you can withdraw anytime, but the later is better. And what is the maximum time you should wait? At best, follow the 4713B limit of 3 years. Or otherwise, a break of a financial year is also good.
Yeah.
But we are not claiming the exemption. Right? I think so we have spent too much time for repeating on buyback. I'll just summarize one point in the context of non-residents. And most likely a philosophical. 115 QA, the tax rate was 18.9 roughly. Now this is taxable as dividend. If you see across the DTW, the tax rate is 5%, 10%, or at max 15%. Whereas for a resident, it is 30-50%. So non-resident is only not getting the cost of what he invested, has to pay tax on gross. It is itself a point of debate. But the tax rate tremendously comes down. Even capital gain, he would be paying at 15%. Now, being taxed as dividend, he will be paying at 5%, 10%. When 115Q, somewhere the underlying intention was to tax non-residents who were not being taxed under the treaties. But now there is a sea change. And the change to that level that a resident has to pay significantly higher tax, whereas a non-resident would enjoy a 5 or 10%. And the treaty rate, there is no plus plus. It is full 5 or 10%, there is no surcharge. In their context as well, but more so on the positive side, there is a possibility they get a cost reduction. There is a possibility that they only have to pay the dividend tax if there is accumulated profit because of the definition of dividend in the treaty. The example what I am giving now, what non-residents would do, they invest big time in startups in India. Now, instead of selling to the new investor, they tell the company to do buyback. Because after 70, really there is no treaty grandfathering for Indian shares. So what you will do is, instead of paying tax at 15%, you will tell the company to do a fresh issue to the new investor and do a buyback of shares which is owned by the non-resident. So they will pay tax at 5% or 10% from the treaty they are coming. And further on the top of it, they will get this capital loss. So they will have a mix of sale to the third person and buyback so that the entire capital loss is absorbed. So example, if I have 100 shares, 80 shares I tell them to buy back so that I book a loss, and 20 shares I will sell at a price to use up this 100% of the loss. So for them, the tax efficiency of using the loss is also coupled in the same transaction. Next is really capital gains. Here, if you ask me, as I started with, it is more of a memory gain, more of knowing, what to do when and what not to do. Otherwise, the topic has already been, discussed at multiple forums. You guys would know more than what I did. I would like to highlight 3-4 key issues and would not prefer taking you after almost a month of the budget through the basics of capital gains, the changes. Everyone is read. Any question happy to address on the subject. But coming to the benefit of indexation, because it came in later as an amendment to the finance bill. 2-3 clarifications. It is only to residents, that to individual and HUs. It is only to reduce your tax burden and it will not give you a capital loss. So if your tax burden, if you want to reduce, you have to look at, it will be available, but if it results in a loss, the loss will be ignored. If there is a sale of multiple immovable properties in a year, you have to make a selection for each immovable property and not on the aggregate basis. The phrase uses, it should be acquired before July 23rd, 24. Whether a gift or an inheritance subsequent to that date will be covered, debatable. Better view, it should be covered because of the entire scheme of 48, but a debatable issue. The phrase used is land or building or both and not immovable property. So whether your tenancy right, leasehold right, or under construction premises would be covered. To my mind, yes, though 50C rulings are there to say the phrase doesn't include. 50C is an anti-abuse provision which requires a comparison with the stamp duty value. It operates in a very different field as compared to the benefit. The benefit is intended to individuals and HUs who have immovable property, basically primarily also residential house. The increase of limits from 1 lakh to 1,25,000 is of 1152A is for the entire year. So even the gains prior to 23rd July are eligible. Gains prior to 23rd July are taxable at 10%, post 23rd July are taxable at 12.5%. So the preference should be to set off the higher rate gains. Depends how it is captured in the IPR utility. On that, in the context of 87A rebate, this year we had many concerns on the utility. I was speaking to Dharan on the sidelines. We intend to again make a representation with actual cases that the on no-name basis, but somehow citing some way to them that assessees have suffered because of your utility. If you have your client use case, we can on no-name basis share in some manner. Would be really helpful if you, we Chamber of Tax Consultants is going to again represent on the subject.
For 45% or indexation. That's it.
July. Everything is July, majority is July. Buyback is October. Only buyback is October and point of transfer, nothing much. This is again to cover this WhatsApp messages, sorry, but second time I am referring to it. That you convert capital asset into stock in trade before 23rd July. Transfer the stock in trade after 23rd July. Because you have converted before, you will get indexation. But the transfer is after 23rd July. So of the stock in trade. So you have to pay tax at 12.5. Same 54F, you have invested the money in the past. Now you withdraw after 23rd July, the lower rate of tax was applied. So I have just given a laundry list of provisions where the transfer has happened in the past, but the taxation is on a subsequent date due to an event like sale of stock in trade or violation of a condition like 4713B, 47.4, etc., or 54F. But if you see, in each of the cases, there is no change in the date of transfer. the transfer continues to be on the particular date. For example, conversion of capital asset into stock in trade is regarded as a transfer under 247, and so the date is fixed. And now if you read the language of section 112, at the rate of 20% for any transfer which takes place before 23rd July. So your transfer has taken place before 23rd July, though it is taxable in whatever subsequent year. It is pursuant to a transfer which has already taken place. And therefore, it doesn't break based on point of taxation. The rate determination is based on point of transfer. And therefore, if the conversion has happened of capital asset into stock in trade, say in 2023, and even if you sell the stock in trade in 26, you have to pay tax at 20% with whatever capital gain was computed after 45 with indexation in that case. See, what does it say? Capital gains of JDA. Capital gain is chargeable in the year of completion certificate is received. Capital gain is computed subsequently and not in the year of transfer and taxed in that year. So basically, your 45(5)(a) doesn't change the year of transfer. It only changes the year of taxability to a subsequent year. So year of transfer as per the court rulings and 247 or 53(a), whatever is the point of transfer, subject to the contradictory court ruling, whether it is a license versus the. Once you determine the point of transfer, it will stick to it. The completion certificate will not change the tax implication. No, owner. Yes. Builder is PGDP, nothing to.
What will be the date of transfer?
Generally, it is, see, there are two things. One is if you have given only a license to enter, then through Shesha Sai Supreme Court, it is regarded when you get the possession, you surrender your ownership. So then it is referred to a future date. In that case, it is say completion certificate. But it was a standard JDA and not a license. You have handed over the possession, received some consideration, and part performance has happened. 53, all the conditions are satisfied, registration and all others. Then the transfer happens then.
At the time of JD.
JDA coupled with possession.
After that, so asset is sold after 3 years.
Yes.
It should be considered as a long-term condition.
Yes. Long term, in both cases it is long term, but taxable at 20%.
That owner is transferred again then.
No, then it is another asset. See, then,
Another asset. So the period of holding will be from the date of joint agreement, JDA, or from the date of completion.
no, so depends. If your transfer has happened, your period of holding starts. If your transfer has not happened, you continue to own the old asset and you are transferring the old assets.
That's what I am asking, what will be the date of say, transfer in case of the main owner? JDA or then the completion certificate.
JDA, both is possible. Depends on the agreement. If license is given, completion certificate. If possession is given and not a license, then date of JDA.
In this case, if the asset is not constructed or whatever in 3 years or 2 years time, lost 2 years, you have to pay capital gain on that.
You are talking about 54 clearly.
Yeah.
Umpteen case laws to say that if it is not your fault, then you are not liable to pay. It is a builder's delay. But one thing one has to be cautious about, which is not so much tested. Now in RERA, they put the date is beyond 3 years. So it is highly debatable whether, you invested when you are not going to get it in 3 years at the outset. Then how can you argue?
Because they're putting 1 year ahead of what the actually.
Yes.
There.
Absolutely, Bombay never comes fixed in 3 years. So people generally opt for this license route that the transfer doesn't have. So that you don't have all this problem. It is just the drafting of JDA. If you will see, it would be, one would follow the Supreme Court SI to get out of 53A of Transfer of Property Act and say that I will be given him license to enter and construct and I'm still the owner. No, so power of attorney, that part of it, so it is well guarded, but for TOPA, it continues to be a license. The commercial rights are of the builder are well guarded in the document.
What is the valuation of the subject when
Valuation about
the capital gain?
stamp duty values.
Stamp duty value. As on the rate of cap completion certificate.
Yes, yes. See, ESOP is not really something impacted, the 50 double A, only one point to know. 50 double A now will hit CCDs and OCDs, if any investors are coming in, would prefer CCPS instead of CCD or OCD. Otherwise, investment in CCD, OCD is being short term. And as I had mentioned, the date of the change in the definition of specified mutual fund is 1st April 25. That's the only change to my mind, which is from 1st April 25. Rest of the changes are from either July or 1st April 24. Corporate gifting, again, not something very usual, one does, but if post 56 to then it has become a even more rarity to look at a company giving a gift or a partnership giving a gift. But now 47(3) is amended, this is from 1st April 24. So even if a gift was given in up to July, it is also covered. And the corporate exemption is withdrawn. Highly debatable that exemption was out of abundant caution. And even after withdrawal of the exemption, there should not be any tax liability. Significantly prone to litigation. But in fact, one may have to argue. Just the most simple facts I would like to cover is a donation of a land parcel to charity. If a company is donating a land parcel to charity, now you are saying 47 is not available. Gift always includes a donation, anything done without consideration is a gift. Gift doesn't mean love and affection. Reasonably a settled position for us. Now, if you donate to charity, you don't have an exemption. 45, very clear. Only taxes on full value of consideration. Doesn't tax you on fair market. But you have 50, which levies a tax on fair market value. Now, if I'm donating to a charity, I'll have to pay capital gains tax considering the fair market value of the property. Highly unintended consequence, but this may affect. Then one will have to fall back on all the technical arguments that why a gift is not chargeable under section 45 in the first place, including the recent Bombay High Court decision of Jai Trust, which has analyzed 50C and 50D and has said both of them don't apply in case of a gift. So they have analyzed a corporate gift because 47. That even if 47(3) doesn't apply, leaving 45, 50C and 50D, even then it is not valid. So then one will have to fall back on those principles and rulings. Whether a gift by a trust is covered or not covered, again, rare issue. One will have to see specifically it is done in the case of family arrangement. One, you had a decision of Bombay High Court, VA Mehta, that corporates cannot be part of family arrangement. But after considering that, there were 2, 3 tribunals who say, okay, corporates cannot be part of the family arrangement, but shareholders can agree to give a gift. And if they have given a gift, the gift is without consideration, so there is no tax. So though you may not cover me in the garb of family arrangement document or the theory of family arrangement, but pursuant to a family arrangement, the partners or the shareholders can tell the company or the firm to act in a particular manner. Those cases would now be, one was enjoying 47 exemption in those cases, but now it would be a debatable position. And a miss or the worst part of this amendment is that there is no cost step up to the recipient. One would assume that if the gift is, you are saying it is chargeable to tax, then at least the recipient should get the cost, the whatever fair value he has. Section 49 is categorical. In case of gift, the cost to previous owner would be considered. Not gift enjoying exemption of 47. So corporate gift still you will not get the cost step up. If you pay tax in 56(2)10, you get that cost. But the cost step up due to the donor, so to say, giving paying tax is not available. Still, even after the amendment for foreign cases, the gift would continue to my mind. It would still scope of section 9 is very limited. If other income under DPWA is not chargeable in India, and one gets out of capital gains, and the right goes to the resident state, possibly the foreign gifting would continue on this. Thank you very much for your patience here.
Anyone has any questions? Mike?
So in case of the buyback, before the October, the now unlisted private company is the family head. So if the buyback needs to be done, is the fair market value FMP of as per 11 is necessary or buyback can be done at any event?
Can be done at any event.
Is there any implication from income tax point of view? Because you have to be considered for the purpose of buyback.
Technically, no. Practically, some may allege 56(2)10, you have to rely on extra finances and that line of rebate.
So it's advisable to get the buyback and it can be
Correct.
and this valuation has to be done on the latest balance sheet or can be done by the smart Batman. Is there any provision the timing for the?
No, basically there is no provision, but 56(2)10 has to be alleged. It is on the date of buyback and not 31st March balance sheet. So whenever you keep a margin, broadly you have some pro forma, keep a margin, though you will have a valuation report, say in October or whenever you are able to finalize. If you are coming at 750, try to buy back at 850.
So margin above FMB should be kept so that there is no
Yes, and general error, general determination of profit takes its own time.
Correct. So no compulsion that it should be done by June or July valuation.
No, there is no compulsion even to get a valuation before.
Okay.
Maybe put some lights on the taxation aspect of REITs and REITs and.
It's nice, the question on read and invent. It would be one of the key benefit which has come in this period of holding amendment from 36 months to 24 months. There is only one item which is moving from 36 months to 12 months, which is listed units of REITs and InvITs. Listed units of REITs and InvITs were earlier at 36 months, though they were listed, that was a specific exemption and an exception made in the proviso. Now that exemption, exception has been done away with. So your units of REITs and InvITs would be taxable at LPCG would be a period of 2 years, period of 1 year. Now it is compulsory listed. REITs before 21 were allowed unlisted. Now all the REITs are mandatorily to be listed. And now you have this concept of SN which has come up, where you will have a single asset in the REIT units which would be listed. Right now, what is there? It is AUM of more than 500 crores is there. It is a bulk of us. The concept of SN has evolved. The regulations are already in place. First approval has been given to property share as well, where you will select each asset you want to invest. For example, there is a warehouse in Buyback. That will be the sole asset of 50 to 100 crores in that REIT. And you will see the yield of that asset, the appreciation on that asset, and then you invest in REIT. And I think the threshold for SN REIT is 10 lakhs, though for main REIT is reduced to 10 to 15,000. Taxation for the investors is broadly simple. Obviously, if you trade in the units, it is long term, short term, and rate depending on your period of holding. If a dividend is declared, then broadly the dividend is exempt in the hand of the units. If you earn interest income is treated as pass-through and you have to pay. And if you earn as repayment of loan, which is a non-income stream that you subscribe to units and they have lent further to the SPVs. And if there is a repayment of loan, to the extent of your cost, there is no tax. If you get repayment beyond your cost, only then there is tax. Basically, except the interest component, whatever proceeds you get from the REIT is taxable. Complexity is more in structuring the REIT. The dividend exemption is only available if they follow the old regime and not if they follow the new regime. So the bigger REITs, what they have done is they have a holding company which follows the old regime, and below that they will have SPVs to hold each asset, which will follow the new regime. So the income would be taxed at 25%, then they declare dividend to the holdco, and holdco will upstream it further and use ATM. So technically it is taxable under old regime, but doesn't have a taxable income. And that is how the REIT structure has evolved to pass on the dividend in an exempt manner. And 56 was amended to provide taxation of loan repayment beyond the initial interest.
And what about the market?
MLD is the instrument frankly of the past now. Because of the amendment, see what they have done broadly, one wants to look at the theme. Any debt-based instrument is to be taxed at your normal rates. So if it is FD interest, you pay under other sources. But if it is not FD interest and you do fanciful planning and make it capital gain, everything is now put into 50 AA as being short-term capitals. And be it market linked debentures, be it debt mutual fund, everything is taxable at the slab rate. that the only exceptions likely to that again would be REITs, where it is a quasi-fixed yield instrument, not a debt simplicity, but again not an equity instrument. You are really earning on the rental yield, but it is still treated as a capital investment, like your immovable property.
Any questions? Yeah, anyway.
Yes, that no change in that grandfather. Yes, yes. So what last time when they introduced 50AA, the grandfather is they provided for debt mutual fund continues. They don't have a grandfathering for market linked debentures, and they don't have a grandfathering for this unlisted debentures and unlisted bonds. For that, reverse your date of purchase is a short term.
Thank you, everyone, so much. So now to propose a vote of thanks, I would like CA Bhavisha.
Mr. Abhiman Mehta has given us do's and don'ts of buyback, capital gains, corporate gifting, especially buyback. We will see that means he has given us a detailed do's and don'ts, and they have given us full details regarding the if buts and questions which we have related to the buyback taxability. So he deserves very well, deserve vote of thanks with a loud applause.
Thank you, everybody. Our next CP session will be on the 1st of September. Down the Senate Hall. We are in the same premises in the Senate Hall. Thank you, everybody.